Growth or AI bubble. Harvey's $15.5 billion AI valuation risk. Harvey's $15.5 billion projected valuation compels you to adopt AI value discipline and ensure sustainable revenue growth. Harvey's reported $15.5 billion valuation, up 41% from $11 billion in March 2026, means you should judge growth by durable economics, not fundraising momentum or market excitement alone. Revenue annualization reportedly climbed from $190 million to $350 million plus. Yet exceeding 44x revenue leaves very little room for execution mistakes, especially when private market multiples reset quickly during downturns. Harvey moved from $3 billion in early 2025 to $5 billion later, $8 billion in December 2025, $11 billion in March 2026, and $15.5 billion, now continuously raising performance expectations. With $500 million potentially raised against $15.5 billion, representing roughly 3% post-money, management must prove capital efficiency through revenue growth, margins, retention, and operating leverage, rather than expansion alone. Legal AI demand is real. 41% of law firms and 47% of corporate legal departments reportedly used generative AI in 2026, versus 28% and 23% in 2025. Harvey's workflows span research, contracts, due diligence, compliance, deals, and fund formation. But you still need evidence that adoption converts into durable revenue, retention, and measurable ROI. L-Impact Solutions sees the valuation fault line clearly, at roughly 44x revenue. A 10% revenue miss, about $35 million, can create multi-billion-dollar repricing sensitivity for investors. A 5-point net revenue retention decline could create more than $1 to $3 billion valuation sensitivity, making 120 to 140% plus expansion, greater than 90% retention, and 75 to 85% gross margins critical economic defenses for long-term value. Foundation model commoditization is dangerous if inference costs fall 30 to 50% annually. Harvey could face 10 to 25% ARPU pressure over 2 to 3 years, despite stronger legal reasoning capabilities and competition. Harvey must prove workflow defensibility through proprietary data, integrations, evaluations, and expertise, embedding itself across 5 to 15 workflows, while competing against 10 to 20 credible legal AI rivals globally. Legal AI reliability cannot be judged by speed. If attorneys spend 20 to 40% of their time validating outputs, assumed 40 to 60% efficiency gains could collapse into under 10 to 15% realized productivity. More than 1,500 AI hallucination cases highlight liability concerns requiring greater than 95% citation accuracy, less than 2 to 3% critical errors, less than 10 to 20% escalation for low-risk tasks, 100% auditability, and less than 1% corrections. Valuation compression from 44 times revenue to 25 to 30 times implies a 30 to 40% multiple re-rating, creating multi-billion-dollar downside, even if Harvey's operating performance remains unchanged during repricing. If annual burn reaches $150 to $250 million, Harvey must generate proportional revenue expansion. Otherwise, negative operating leverage can weaken financing flexibility, as enterprise budgets tighten 5 to 15% during downturns. Harvey should target greater than 120% net revenue retention, 12-18-month CAC payback, greater than 70% gross margins, and 30 to 50% of new ARR from existing customer expansion for healthier SaaS economics. Workflow depth should connect DMS, CLM, and e-discovery systems across 5 to 15 processes, while proprietary architecture aims to reduce churn risk by 5 to 10 points versus baseline SaaS benchmarks. Cutting a legal process from 40 hours to 15 hours creates 62.5% time savings. Harvey must translate that into labor savings, counsel savings, faster deals, and 2 to 3x stronger expansion. The $500 million financing could allocate 40% product come infrastructure, 25% sales, 15% international, 10% acquisitions, and 10% liquidity, with sales requiring 1.5 to 2.0x incremental ARR within 12 to 18 months. L-Impact Solutions recommends stress testing 50%, 20%, and 40% growth scenarios, 20 to 30% pricing compression, 15 to 25% higher CAC, 10 to 20% inference costs, 5 to 15% margin pressure, and 25 to 40% valuation contraction. With 559 court opinions, Thomson Reuters at $1.95 billion revenue and 32% AI-linked contract value, Harvey faces 10 to 20% pricing pressure, 23K jobs lost, 4.1% unemployment, and 3.6% inflation above 2% target. Can Harvey justify its $15.5 billion valuation, or face a reset? Comment your answer below. For more analyses, visit our consultancy website. Link in description below. Thank you.